Okay, Assalamualaikum warahmatullahi wabarakatuh. Hi everyone, my name is Selvi Octavia Damayanti. My class is 2J Management Accounting and my attendance number is 17. In this video, I'll be explanation about the stage of audit. Auditing is not just about checking numbers in finance statement. It's a highly systematic and structured process with clearly defined stages. One from the very beginning all the way to when In this video, we'll go through each one from the very beginning all the way to when the auditor issues the final report. What is the audit stage and why it is important? So, the audit stage are a series of steps the auditors perform in sequence, from planning and testing to the issuance of the final report. And why it's important? Because without clear stages, auditors make overlook crucial details. Audit stage ensure the process is structured, comprehensive, and the results are trustworthy to all stakeholders. Okay, there are four phases in audit process. The first one is planning and implementation design. This is where the auditor plans and design the audit approach. Think of it as the preparation stage before the audit goes in the field. In the phase 2, there are test control and transactions. This is where the auditor starts testing is the client's internal control working properly, are transactions recorded correctly. And in phase 3, there are substantive procedure and balance. This phase focuses on account balance in the financial statement. The auditor tests whether the numbers in the balance sheet and income statement are reliable. And in phase 4, there are disclosure and audit report. In this is the final phase. The auditor compiles all evidence, evaluates findings, and issues the audited report. All four phases are interconnected and cannot be separated. The outcome of one phase directly affects the next. Now, this is the complete diagram of the audit process. You can see there are for the phase, you can see four flash box from top until bottom. Each representing one of the four phases. Within each page, there are more specific steps. What interesting in the phase 2? There is a decision point. The auditor has to decide whether to perform tests of controls or not. This depends on the risk assessment done in phase 1. And in phase 3, there are three different paths depending on the assessed level or misstatement risk. It is low, medium, and high. And then in the first part is complete the audit and issue an audit report. This is the diagram we're going to break down step by step. Let's start with phase 1. The phase 1 is planning and designing the audit approach. This phase is the foundation of the entire audit process. Without proper planning, the audit won't be effective. There are eight case date steps here. Steps one is accept client and perform initial audit planning. This first step is accepting the client and performing initial planning. Before a public accounting firm accepts a client, they need to evaluate first. Does the client have a good reputation? Is the risk too high? Once the client is accepted, the audit team is formed who will be the partner, senior auditor, junior, and so on. Step two, there is understand the client, business, and industry. An auditor can audit something they don't understand. That's why the second step is understanding the client, business, and industry. For example, if we're auditing a palm oil plantation company, we need to know how the industry works, harbor seasons, CPO price fluctuations, export regulation, and so on. This understanding is essential for identifying which areas carry the highest risks. And then in step three, there is perform preliminary analytical procedures. These are early analytical procedures. The auditor compares the client's financial figures against historical data, industry benchmarks, or their own expectations. For example, last year the gross margin was 13 30%, but this year it's suddenly 15%. What happened? Anomalies like this become the auditor factors going forward. And then in the fourth one, there is set preliminary judgment of materiality. This is a very important concept in auditing. Auditors don't check every single cent. They set a threshold what amount of error will be considered material or significant to financial statement users. And the fifth one, there is identify significant dispute to fraud or error. The auditor must identify significant risk from fraud and error. Fraud is typically associated with complex transaction-related party dealings or management pressure to hit certain targets. This step is critical because it determines where the auditor needs to be most vigilant. And in this step six, there are assist inherent risk. Inherent risk is the risk naturally attached to an account or transaction without considering internal constraints at all. And then the seventh one, there are understand internal control and assess control risk. After understanding inherent risk, the auditor needs to understand the client's internal control system. Is there an adequate system in place to prevent and detect errors? And then the last one is finally overall audit strategy and audit plan. An audit plan. The the first step in phase one is developing the evaluation strategy and plans. In the phase two, the auditor performs tests of control and substantive tests of transactions. The decision here is will the auditor rely on the client's internal control or not? If yes, the auditor tests whether those controls are actually working in practice, not just on paper. And then, if no, the auditor skips control testing and goes back to more intensive substantive testing. Either way, the auditor will still perform substantive tests of transaction to verify whether recorded transactions are accurate, complex, and actually accurate. The result of this phase determine how deep the testing needs to go in phase 3. Mm. And then we go to phase 3. In phase 3, the auditor focused on account balance in the financial statements. The level of testing depends on the risk level from phase 2. If the risk is low, the auditor only performs substantive analytical procedures, comparing financial figures against expectations. If the risk is medium, analytical procedures plus tests of key items focusing on significant or unusual transactions. If the risk high, all three must be done. Analytical procedures, tests of key items, and additional tests of details of balance. The auditor, the auditor may also need the right confirmation from third parties. Now we are at the final phase. It's phase 4, completing the audit and issuing this report. In the first, the auditor performs additional tests on presentation and disclosure, making sure everything that needs to be disclosed is properly disclosed. And the second one is accumulated final evidence. Accumulate final evidence and review the audit working papers. And the third, evaluate the overall results. Are there any material misstatements? Is everything within the material threshold? And the fourth, issue the audit report. This is the final product, the auditor opinion on whether the financial statements are fairly presented. And the fifth one or last one is with communicate with audit committee and management, including any significant weakness found during the audit. And we move to closing conclusion. So, in phase 1 is about planning, and the phase 2 is about testing control and transactions, and the 3 is about testing account balance. And then in the phase 4 is about completing the audit and issuing the report. Every phase matter and each one builds on the previous. That's what makes the audit process systematic, proud, and trustworthy. That's all from me. Thank you so much for watching. Wassalamualaikum warahmatullahi wabarakatuh.